Hi guys and gals, welcome back to the channel. I hope your day's going well, and thanks for spending some time with me. Today I wanted to cover another company valuation method which can give you a good price to pay for a business. And the great thing about this method is that it doesn't require you to have a predetermined idea of what the growth might look like out into the future. So this method is called the 10 cap method, and it's another of Phil Town's creations, which is based on elements drawn from Warren Buffett, a calculation he had for something called owner earnings back in the day. But check out some of my other videos for explanations of other company valuation methods if you're interested. So without further ado, let's get right into it. So the 10 cap method, or 10% capitalization method. It applies to businesses what is applied to real estate. If you were to buy a house to rent, you want to know that the rent you could get and what it will cost you every year just for the upkeep, for things like repairing things, council tax, insurance, to be able to work out what your yearly income would be. That figure is called the owner earnings. Then you would want for that owner earnings to be linked to the price that you pay. And the way it's linked to the price that you pay is you want it to be 10 times the owner earnings figure, or less. The key thing about being able to do a 10 cap is that you're highly confident this business will be larger and more productive in 10 years. And that obviously comes from your understanding of the business and your own research. You can't take a long view of a business that you don't understand. If you were buying a rental house, you want to be confident that the rents will be higher in 10 years. And that confidence tells us, the confidence that you have tells us that the business will be larger in 10 years. Right, so let's get stuck into the calculation, how we actually calculate the price to pay in this 10 cap method. So there's three things that we need to calculate the 10 cap price, and I'm going to go through them for you now. First of all, the first thing we need is operating cash flow. When Danielle and Phil Town wrote their book Invested, they talked about owner earnings, and they found a formula of Warren Buffett's and his formulation for calculating owner earnings. And the thing is, Warren Buffett was making that analysis of owner earnings in 1986, and in 1986, basically there was no cash flow statement. Just the income and the balance sheet. And then people were concerned that you weren't getting the full picture of a public company. And Warren actually came out and said that we need a cash flow statement. And that's the kind of thing that he was kind of getting around and applying with his own formulation for what he called owner earnings. So CPAs have gotten together, and we now have operating cash flow and the cash flow statement. CPAs have said that it was a good variation of this, but the best value to use as a starting point for calculating operating earnings is to use operating cash flow. And Danielle said she always struggled with the old formula for calculating operating cash flow. I'm not going to go through it in too much detail because it is an old method, but I went through a period where I was calculating the 10 cap method using this other more long-winded formula, and it was a bit more cumbersome. But the old method was certainly a good attempt. So that's the first thing we need, operating cash flow. So the operating cash flow that you need, you have to use a historically reasonable operating cash flow. So this means that when you're looking at a business over time, you're not going to be using an outlier as a starting point for figuring out the 10 cap. You can have astonishingly good years, but we need to make sure the operating cash flow is consistently predictable and in line with numbers where you're confident that it is a reasonably historically reasonable operating cash flow for that point in time. If you're looking at a crappy year, then that's only going to make your valuation more conservative. But don't use a high outlier, basically. So that's the first thing we need: operating cash flow, historically reasonable operating cash flow. So we get that, number one. The second thing we need to look at is capex, but more specifically, maintenance capex. And again, we need to use a historically reasonable maintenance capex. And you could do things like one of the good ways to try and hunt this down, maintenance capital expenditure, is to look in 10Ks, and you kind of Control F or Command F and look for where capital expenditure is mentioned. Look for where they talk about maintenance capex in the investing notes, in the cash flow section. They'll normally discuss in some detail what they spent in capex like last year, and what they might predict to spend in capex for the following year. And what you're hoping for is that they also discuss the breakup of maintenance and growth, but most don't split it out. After a lot of research, however, Phil and his team, they concluded that the percentage range of maintenance capex runs anywhere between 20 and 80%. Almost all companies have some growth. Okay, on average, this will be about 50% if you don't know otherwise. So unless it's like a railroad or something where maintenance capex is huge, then a default you can use is 50%. But it's not a get out of jail free card. Using 50% doesn't let you off the hook for not trying to come up with a better number, but at least you are armed with the knowledge that 50% is a good default. So 50% of the capital expenditure for growth and 50% for maintenance. And you should know that 50% is a kind of a reasonable guess. If you don't feel comfortable, and confident enough to make a good guess, then maybe you don't know the company or the industry well enough. And you have to be honest with yourself, because it will only be you that pays for it down the road. Okay. You need to know that you're at least in the ballpark. And you know that the 10-cap method is giving you a big margin of safety price anyway. So that if you've gotten it a little bit off somewhat, then we know that we're still getting a margin of safety. So operating cash flow is the first number. Then we need to calculate maintenance capex, both of them historically reasonable. The third thing we need is to calculate tax provision, and that comes from the income statement. Both operating cash flow and maintenance capex or capital expenditures, those are both on the cash flow statement. Most of the time, capital expenditures are on the cash flow statement as a line of called purchases of plant, property, and equipment. So look out for that line as well. And then tax, you'll be looking on the income statement. And what we're looking to come up with, we're looking for a pre-tax number. That's why we want to find out the tax. We're looking for a pre-tax number that you can then compare to a rental house or a farm, a building, or a company, so that we make sure we're comparing apples and apples. And it would be hard to find a house that you could get a 10% yield on, and that's why it's such a good price to buy a company at, the 10-cap price once you've calculated it, because it's really difficult to get a 10% yield on your purchase price without any growth. The point being, a 10-cap has a lot of margin of safety in it, basically. Income tax comes from the original method, the original formula for owner earnings, which was basically net income plus or minus depreciation, amortization, and then net changes in accounts receivable and accounts payable. But now operating cash flow replaces that. The rest is the same. Basically, you take operating cash flow minus maintenance capital expenditure plus tax provision, and the number that you get at the end is your owner earnings number. So that's basically the formula. And you want to be confident. to have the understanding that if you owned the business, then you could really pocket the owner earnings. Look at it like you would a rental house. You want to be sure that after all your expenses that you've used to, repair the windows, replace the washing machine, keep the boiler up to scratch, that after all that, once you get your rent and you take away your expenses to maintain the business, to maintain the rental property, that you could actually take those that profit that's left over and pocket it. We want the owner earnings to be a real number, and one that you could really take out of the business. And you want to know that if you took it out of the business, that the business could still operate without it. The last and final step, apart from hitting like and subscribe, the last step is the easiest. You just take that number, you just multiply that number by 10. And then you have your 10 cap value that you can buy the whole business at. Divide that by the shares outstanding, and then you have your 10 cap price per share to pay that you'd like to buy the business at. Another checklist item that we can look at, and one that I quite liked to use, is that it doesn't mean you're going to do this, but you want to be confident enough. It's all about being confident and kind of judging your own conviction in your own research and your own calculation. You want to be confident enough at that price that you would put 20% of your net worth into that business. It's not to say that you should be having a 20% position, or that you should be allocating that much of your net worth to the business, but you want the confidence to be high. You want the confidence to be there that you would put 20% in, and you would be able to sleep well at night if you had that. So yeah, that is the 10 cap method. And we didn't have to have any idea on the rate at which the business is going to grow. Just that it's a wonderful business and it will be bigger in 10 years. So I really like this method. I always do it when I'm evaluating a company. I always calculate the 10 cap method, because if I can get it at a 10 cap, I know that that's a great price to pay, because it's such a conservative price. And I always calculate it because I like to compare it to where my other buy prices kind of come in, so I can get a range. And if the 10 cap is way off my other prices, then I like to just know that and have that knowledge. So hopefully I haven't confused you all. If you have any questions or comments, I'd love to read them below in the chat. I will let you get back to your day. So with that said, let's all go out there and become super investors together. I'll catch you on the next one. Take care.